Hi there. My name is Christian Ross, and I'm an attorney with Campbell and Brannan. And I wanted to take this time to talk about adding someone onto title of your property, specifically real estate, but adding them onto title and they're not your spouse and they don't fall under some of these exemptions for tax purposes. And I get this question a lot. Any attorney in real estate would get this question a lot because naturally, as people start getting older and they start thinking about what they want to do regarding their retirement and their estate planning, they try and cut corners, they try and simplify things, they try and save on money, and unfortunately that leads to some poor decisions. And so I want to kind of walk you through a couple of scenarios that I see quite often, see if I can provide you a little bit of education as to what I typically tell my clients, and then finally how we get it done. So the first thing that tends to happen is if someone calls us, we ask them to give us the information because we're only as good as the information you give us. And honestly, what we love to do, I've created this form on our website for deed preparation. So you go to campbellandbrannan.com/deed prep. Try to make it as simple as possible. Scroll down and click the link, and you're going to type in the information. So your name, your email, phone number, the property address, what county we're in. We've got the owner's name. And then what are we doing? Are we going to add someone to title? Are we adding our spouse to title? Or are we taking some away? So are we, is the husband coming off of title? Are we conveying it into or out of a trust or a LLC, a corporation? And then what, the last one, which we tend to see quite frequently, is pursuant to a divorce, or even an estate, maybe someone's passed away. So what we're going to know, we want to ask then, who's the new person or entity being added to title? And you can put multiple people on there. And then any other specific instructions, some disclosures, they type their name and they push submit. So that is great. It provides a confirmation to the person filling it out as well as the attorney that's working on your claim. So now let's talk about the situation where we're adding a spouse. There's no tax consequences of adding a spouse. So I have no reservations. I don't spend a whole lot of time or energy trying to educate people on whether they should do it or not. Obviously, I'll answer any questions they may have, but people can freely add their spouse to title or take them off kind of without consequence. So happy to do that, pretty straightforward. You can use a quitclaim deed or a warranty deed, a limited warranty deed. It really shouldn't matter unless there are special circumstances. But we get it done, have everyone sign it, gets witnessed and notarized, and then we can record it down at the clerk of court. Where it gets more complicated is when we're adding someone who is not their spouse. So if we're adding their children, if we're adding it into their LLC, if we're putting it into a trust, things like that, it can be a little bit more complicated. And the most complicated portion is when we are trying to do estate planning by adding children onto title, or adding a fiance onto title, or maybe a boyfriend. Because there are tax consequences potentially, especially if that spouse or that non-spouse hasn't contributed towards the house, isn't paying the mortgage, didn't put up part of the down payment. So most recently I was asked about adding a daughter onto title. The owner of the property was in late, her late 70s maybe, and they wanted to make sure that if something were to happen, that it just very easily hands over to the daughter without having to go through probate. And I think that's wonderful, it's great, but I asked them a few questions. I said, have you talked to your CPA or your accountant regarding any gift taxes or the lifetime exemption or estate planning or any of that? And they had answered no, we hadn't discussed that. And I said, well, typically what I like to do is tell clients about estate taxes, how it works, some of the things that we need to take into consideration before we actually do it. So I've got some information up here just by doing a search online. The IRS allows a lifetime tax exemption on gifts and estates to a certain limit, adjusted yearly to keep up with inflation. As of 2019, that total was $11.4 million. That is the lifetime exemption for basically gifting property. Now that's, in other words, you would call that the estate tax exemption. So for all of your assets, let's say I pass away In 2021, all my assets, as they're being conveyed out to my heirs or beneficiaries, there's no taxes on those transfers up to that amount, that 11.4, 11.5 million. Anything beyond that, it gets a little trickier. So it looks like it's 11.7 for 2021. So if I had assets greater than 11.7, then my estate would be subject to estate taxes, and possibly the heirs would as well. During your life, though, we can still take advantage of that exemption. So right here on the IRS website, you have a form called the 709. Anytime that a gift is given to someone inter vivos, so during their lifetime, there's the annual exemption, which is $15,000. Anything beyond that, you might have to, reduce your exemption from your death tax exemption. So you basically take that 11.7 million and you start deducting it during your lifetime, so that when I do pass away, let's say I've given away $1 million worth of property and other assets during my life, when I pass away, my estate is going to be whatever that exemption is minus the $1 million that I've already given away. So now my estate, they're going to be subject to taxes once we hit, say, 10.7 million, something like that. Again, it sounds a little silly for most of America and most of my clients. That's just not our situation, and that's an individual. If you had a spouse, you'd have double that exemption amount potentially. So, but we still have to do it. And so in this scenario, when this mother was wanting to put her child onto title, we had to take this in consideration and make sure that when she files her return that she includes Form 709, or in the very least, and I'll make the disclaimer now, I'm not a tax attorney, I'm not your CPA, so you really do need to talk to an expert before making these decisions, but that your CPA has to be on board with, yes, we will make sure that we account for this on your next tax return. We'll fill out the form and we'll reduce that lifetime exemption accordingly. All the information is online, but see, it says here, if you are a citizen or resident of the United States, you must file a gift tax return in the following situations. Number one, if you gave gifts to someone in 2020 totaling more than $15,000, other than to your spouse. So again, giving money to your spouse is not a taxable event. Certain gifts called future interest are not subject to the $15,000. We'd have to look further into that. Spouses may not file a joint tax return. Again, a spouse thing. If a gift is community property, it has different taxing. Likewise, each spouse must file. Only individuals are required to file gift tax returns if a trust, estate, partnership, or corporation makes a gift. The individual is liable for the gift and GST taxes. So there's a lot here as well. So who does not need to file? Let's look here on the bottom. If you made no gifts during the year, you did not give more than $15,000 to any one donee, and all gifts you made were of present interest. So really, in this scenario where we're putting our child onto title, it may not seem like a gift because the mother still believes that this is her house, but by putting her onto title, she has 50-50 owners with her now. If there was $200,000 in equity, now there's $100,000 owned by the mom and $100,000 owned by the daughter. And so that's a $100,000 gift made inter vivos, and we'd have to file 709 according to these instructions. So that's the big thing, is that if you're going to do this, if you're not worried about that lifetime exemption being limited, if you still want to move forward, great, that's wonderful. Just make sure that you've already discussed this with your accountant and you're planning on filing the proper returns. Here's what the form looks like. You'd fill it out and you would include it in your return. Now, the next thing that we have to consider is stepped up tax basis. So this is another thing that I would always tell my clients. Now, this may change year to year, and any tax code could change year to year. In fact, it could change halfway through the year if Congress so deemed it. But at the moment, stepped up tax basis is a wonderful tool for estate planning. And here's how it works. Generally, if you inherit the property, so upon my death, my children inherit my property, they no longer have a cost basis as to what I paid for it. They inherit based on what it's worth upon my passing. So if I died today, even if I had bought a property, 50 years ago and I paid $10,000 for it, now it's worth $1 million. Well, if they sold, they would get what's called stepped up tax basis, and they would inherit the property at that $1 million valuation. So if they then turn around and sell it, their basis is $1 million and their sale price is somewhere around $1 million. They really wouldn't have any taxable gains. So it's actually a wonderful tool. Whereas if I sold it the day before I passed, I would have long-term capital gains between that 10,000 and the million, so 990,000 of taxable gain. And that could be, depending on your tax bracket, it could be a significant tax bill. So that's item number 2, is that I was saying to the daughter in this case. So for the mother, I told her about that estate tax thing. Look, you don't want to pay more taxes than you have to. And then I say to the daughter, I say, look, if you then turn around and sell it, you're going to be paying this tax if you just get added to title rather than inherit it. 10 years from now, if you want to sell or you need to sell, I'd rather you have that stepped up tax basis and save all that money in taxes. So between those two things, my clients decided not to move forward with it. Instead, they decided to talk to an estate planning attorney and update her will and just make sure that when time comes that something does need to happen, that they're prepared for it in that way. So alternatively, I do get a fair amount of clients that even with all that information in the same circumstances, they come back and they say, we still want to do it. And that is fine. That's great. What we'll do is I'll draft the deed, we'll get it signed, we'll get it recorded down at the county, and then we will give back a copy to the buyer so that they have that notice. And a couple of things that they'll want to do here in Georgia afterwards is reapply for their homestead exemption, update their insurance to make sure that they're an additional insured on the policy, and then possibly if there's a mortgage, they may want to update the mortgage company as a beneficial owner of the property, or like a joint tenant owner. And that kind of leads to the last part. How do they want to hold title? And this can get complicated when there are multiple parties involved, when there might be a second marriage or anything of that nature, because you can hold title as a tenants in common or a joint tenant with right of survivorship. And either one is fine. Either one will convey ownership to the new owners, but it does change what would happen upon your death. So on a tenancy in common, if you have two parties and one of them passes away, let's say I pass away and I've added my daughter onto title, she now owns 50% of the property, but my estate still owns the other 50%. And she might be a beneficial or an heir under my estate, she may not be. But it would require probate, it would require a lot more work in that case to make sure that that title was merged. Alternatively, if you have a joint tenant with right of survivorship, you still have the two same parties. I pass away, and per the terms of that language, now my daughter is the sole owner of the property automatically. Title merges entirely into her because I have passed away. So it skips my estate entirely. There's no need for probate in that case. Could potentially save a lot of time and money and aggravation. So that obviously you can tell, coming full circle, the reason why a lot of clients are intrigued by this is that automatic merging of title and the saving of the headache and the time and the money required for probate. But the downsides, the missed opportunity on the stepped up tax basis, as well as the simplicity in filing the proper forms for a lifetime exemption. There's a lot of benefits to not doing anything, to leaving sole ownership in that parent, keep it simple, and just update your will, update your information, and do a good job educating your children or whoever is going to be inheriting the property later. I hope that's helpful. This is not meant to be a fully detailed disclosure on this or an education. It's really just to give you the basics, to help you do a great job of explaining it to yourself or your spouse or your clients. And if you do have questions, please seek legal advice or CPA's help in filing the proper returns, and don't rely entirely on this information. But I wish you the best of luck. If you need anything from us, please don't hesitate to reach out to us. You can find us online at campbellandbrannon.com. Thank you.